Investing in mining companies, how important is location? There must be a lot of factors to take into consideration when looking at a mining exploration company and where it may be looking to mine in the world.
Absolutely, jurisdiction is one of the major risk factors in mining, but ultimately I'm location and jurisdiction agnostic. The one thing I'm not agnostic about though is price. If I'm, with no offense intended to the people of the DRC, it is generally considered to be a riskier jurisdiction. But if I'm rewarded for taking that risk with a low price, then I will probably invest in the DRC. For the right project, with the right management, and the right discount, I'll consider that investment. Now, I wouldn't suggest you put it all into high-risk jurisdictions. Like everything, diversification is what allows for long-term investment returns. But ultimately, you're looking for ultimately you invest to get a return. And if the discount is sufficient, you are often willing to take that investment risk.
There must be some red flags that are identified, that you will identify when looking at companies though, outside of jurisdiction. What would those red flags look like to you?
I guess management is actually incredibly important. From finding something, to developing it, to financing it, to permitting it, to pouring your first metal, there's a huge number of stages, and it's complicated. And management that has done it before, realistically, is more likely than not to do it again. And management that's failed before often will fail again, and there's often a reason for that. So the track record of management is incredibly important. And by track record, I don't mean just reading the bio on their website that gives their greatest hits. I mean, how many successes have they had and how many failures have they had? And that goes back into our early discussion about a proper manager who has history in the industry. It's hard sometimes to get a background on people, but people are incredibly important. And knowing the background of the people that you're investing in is often more important than what's actually in the ground.
So you wouldn't necessarily invest into a company if the manager didn't have a track record. Let's say they've come from somewhere else in other industry, let's say, I don't know, would that put you off entirely, or?
No, not entirely. And mining isn't done by one. I know you often see a CEO who's the face of a company, and that can be anyone. But mining is a team effort. There's no way to individually mine something. So if there's someone new to the industry, but that also has a team around him with a lot of experience and success in their background, they might be safer. It's also quite unusual to get someone who's made it to the CEO level and not had any experience in the mining industry. So that would be a rare occasion. But on the whole, a couple of new people aren't going to hurt you, but some experience within the team, or a lot of experience within the team, is usually something I would consider quite highly in my choice.
So obviously we're talking about management team, but there must be other factors you look at. So you've got a mining company that wants a portion of your investment, and you go and sit down with that company. What are the other sort of factors that you're going to be considering before actually portioning some of your fund's money into that company?
I have a table model that I've put in for investing, and a table's generally got 4 legs. And I think the 4 legs that hold up a mining company are, on one leg you have the asset itself. Do you have a good asset that's reasonable enough and sufficient grade that can be mined from a sort of technical perspective, from a geology and engineering perspective? On the next level, you have the next leg, you have the management. Do you have the ability within the management team to execute that from beginning to end, to get your company to where it needs to go? And that's a skill set. The next leg of the table for me is financing. It often takes between a minimum of 5 and usually approximately 10 years, up to 15 years, from finding minerals to actually pouring metal out. And you need to be financeable. And that means the quantum has to be a reasonable amount. When there's money coming from everywhere, when you're at a certain part in the cycle, you can get $1 billion or $2 billion or $3 billion to build a mine. In a bear market, it's really hard to get $1 billion to build a mine, but 100 million is a more reasonable bite-size amount. The reality is certain jurisdictions are harder to finance than other jurisdictions. So I might be able to get X million to build in Canada or Australia because they're first world safe jurisdictions banks are willing to lend against, people are willing to invest in. But it'll be a lot harder for certain countries in Africa. So I make a general call on whether or not this project is financeable within the economic environment we're in at the time. And the last leg is the leg that most people don't like because it's not technical at all. If you're a public company, you have to appeal to the general public. That means you have to appeal to the institutions like myself that invest in you. You have to appeal to the lenders. You have to appeal to the retail public, which actually play a huge role in driving the price. And your ability to promote yourself as a company is essential. You have to have a public face. And many companies that are run by very talented financiers and geologists and engineers forget that they're running a public company and you have to be attractive to the general public, and they completely forget that is a leg. Now, a table can be wobbly and stand on 3 legs. It can't stand on 2. So if you don't have all 4 of those legs, the promotion, the financing, the good asset and good management to execute it, true success requires all of those things, and you can get away with 3 of them and find a way to fix the last one, but you can't get away with just 2.
So they have to, these companies have to be well marketed. They have to have good PR and all of those aspects. Or if they didn't, would you go in and say, look, we like you, but you need to sort this element out of your business. We'll see you in 6 months or 12 months' time?
Absolutely. And often when I see an asset, it's at a slightly earlier stage where it hasn't been necessary to promote themselves at that point in time. And that promotion marketing end is the weak link. As I said, you can stand on 3 and get the last one. Yeah. Just like if you've got incredible geologists but not really good engineers, and you're not there yet in terms of management, you can hire those eventually and fix it. Companies evolve, they get better over time and they learn. If you have the basic building blocks, you can probably get the rest of them. But if you don't have enough of the basic building blocks, you're never going to get there.
Wow, that's amazing. Coming back to your point you just mentioned about the retail investors drive the price, I find that fascinating because most people out there believe it's the institutions that are driving the price of these companies.
The institutions buy in large blocks, right? And they tend to buy when they're financing some phase of their expansion. And that money goes in and it takes a long time to come out. You know, if I'm buying a percentage of a company, I can't flood the market with that stock. I'd flood my own, I would flood the market and I would lose the price and I would decrease the value. I would hurt myself by doing it. The buying and selling that is largely based on sentiment at the time for the company, often, and the price driver, in my opinion, is often the retail market.
And the bulletin boards.
Yes, the bulletin boards are definitely a part of it. I don't think the bulletin boards are a great place to get facts, but they are a good place to gauge sentiment. And sentiment does play a large role in pushing prices up or down.
So that then leads us back to things like the core prices of something like gold itself. So when general market sentiment starts to become more bullish towards gold again, that's only going to help the mining companies. Absolutely. So they lag the gold price, yeah?
Generally, yes. But in the market we have today, they actually tend to be the time lag between information getting to the market and people trading is a lot faster. With the internet, you know, the price goes up 2 minutes, the bulletin boards are on 3 minutes later, and the price goes up 5 minutes later. So you can have really quick reactions to market information faster than it's been in the past. But nonetheless, they are all intrinsically connected and they come one after another.
Wow, it's it's a fascinating thing. Like you say, with Twitter feeds and everything now, and so much information can be measured on chatter now on social media globally that it can actually people can make decisions on individual stocks based on social media.
Yes, if you're trading purely on sentiment, then you can make decisions on buying and selling.
Not saying you would, no.
But if you want to invest for longer than a few hours, then I think you need a combination of sentiment, short-term and long-term, fundamental metal prices, and actual quality of the company. Like they're all intrinsically linked. But there's a lot of people that make short-term money on sentiment, and it's part of and I don't want to necessarily undervalue those people because they're part of a vibrant and functioning market. To have the guys who invest and stick it in their pension fund and we'll see you in 10 years, and the guys who I'll see you in 10 minutes. They all have a role to play in keeping the market transparent and functioning properly.
It's amazing. I heard a story not too long ago about there's some people now well, it's probably a lot on Twitter. They have a big following. They'll put out a call on a small stock, and by the end of the day, they've made a heck of a lot of money because the following all get into the price. This is all unregulated, obviously, and then they sell out probably. As everyone else is still buying in, they've just made themselves a huge amount of money. But the price has genuinely flown very, very quickly because of these media that we have nowadays.
Absolutely. Twitter has changed the world, as have the bulletin boards. I think you need to be very careful with that because market manipulation, putting out false rumors, is a crime. And people who have done it, and if they can get caught, if you can track the person who put out the rumor and it proves to be false, that is market manipulation. And I would like to think that our system will eventually stop those guys from doing those kinds of things.
It's just moved on from years ago when people used to talk to the guy down the pub, isn't it? Hasn't it really? You used to talk to the guy down the pub and tell them about this wonderful share price that you've seen, whereas nowadays it's all just instant.
Well, when I first came to London, I remember some of the guys in the market telling me, they got their best gauge of sentiment from talking to London cabbies. I'm not sure that's still the case, but
well, the Uber taxi drivers, I don't know.
Things have definitely changed. But there's a million ways of getting sentiment indicators, whether it's the guy down the pub, the bulletin boards, the cabbie. They're all part of the world we live in, and part of me kind of likes that. I like the vibrancy of that.